Did you know we might be on the verge of a stock market crash just when you least expect it? Have you wondered how global political and economic tensions are impacting your investment portfolio? Would you like to know which economic indicators are in the red and how you can protect your savings before it's too late? In the next few minutes, we will reveal the most alarming signs of a possible market crash and what you can do to protect your money. Stay with us because this information can make the difference between losing everything and being prepared. Let's get started. Sign 1. Political and economic instability. Political and economic instability is a key signal of a possible stock market crash. Geopolitical tensions, such as conflicts between major economic powers, can cause investor uncertainty. A recent example is the trade war between the United States and China, which has generated market volatility. Internal political problems also have an impact. Unstable governments and abrupt changes in economic policies can cause panic. Recently, in some European countries, disputes over fiscal policies have increased volatility. Economic slowdown in major economies like China or the United States is also worrying. When these economies show signs of weakness, investor confidence decreases, which can lead to massive sell-offs. Another risk is the high level of debt in many countries and companies. If they cannot meet their obligations, it can trigger a crisis of confidence. Finally, the monetary policies of central banks play a crucial role. Changes in interest rates can generate uncertainty and market volatility. In summary, political and economic instability is a clear signal that we might be approaching a possible stock market crash. Geopolitical tensions, internal political problems, economic slowdown, and debt-related risks are factors we cannot ignore. It's crucial to stay alert to these signals and prepare our investment portfolios for possible market turbulence. Sign 2. Negative economic indicators. Negative economic indicators are fundamental for identifying a possible stock market crash. One of the main indicators is the gross domestic product, GDP. A slowdown or contraction in GDP suggests that the economy is not growing as it should. Recently, we have seen worrying reports of slow growth in several major economies, which can negatively affect stock prices. Consumer confidence is another key indicator. If consumers are worried about the future and reduce their spending, company sales and profits can decline, affecting their stock prices. Currently, consumer confidence has shown signs of weakness in various regions. Industrial production is also crucial. A decline in production can indicate lower demand and affect companies, which is reflected in the stock market. Additionally, the unemployment rate is an important indicator. An increase in unemployment reduces consumer spending capacity and can lead to a drop in stock prices. Finally, consumer price indexes, which measure inflation, are critical. Uncontrolled inflation can erode purchasing power, while prolonged deflation can indicate weak demand. Both scenarios are unfavorable for stock markets. As you can see, a GDP slowdown, a drop in consumer confidence, a decline in industrial production, rising unemployment, and unstable inflation are clear signals of a possible stock market crash. Sign 3. Market behavior. Market behavior is a crucial signal of a possible crash. Volatility, or the frequency and magnitude of changes in stock prices, can indicate investor nervousness. A recent increase in volatility suggests uncertainty about the market's direction. Overbought or oversold signals are also important. Overbought indicates that prices have risen too quickly, while oversold indicates the opposite. Many analysts point out that several sectors are currently overbought, which could suggest an imminent correction. The behavior of large investors and investment funds is another key factor. If these players start selling large amounts of stocks, it can be a sign that they expect a market decline. Massive selling can trigger a chain reaction and a more pronounced drop in stock prices. Market liquidity is also crucial. Less liquidity means it can be harder to sell stocks without significantly affecting the price, which can increase volatility and the risk of a crash. Finally, trading volumes are important. A significant increase in sales volume can indicate that many investors are trying to exit the market at the same time, which can be a sign of panic. In summary, volatility, overbought or oversold signals, the actions of large investors, liquidity, and trading volumes are key factors that can indicate a possible stock market crash.
If this video is opening your eyes to finance, hit like to support this channel and help us keep uploading more content. Comment on your biggest revelation so far and subscribe with the bell on so you don't miss any financial secrets. And if you have a friend or family member who could benefit from this video, spread the word by sharing it. Let's continue with more strategies that will change your financial future.
Sign 4. Inflation expectations and interest rates. Inflation expectations and central bank interest rate policies are crucial signals for the market. Inflation affects consumer purchasing power and company costs. High and persistent inflation can lead central banks to raise interest rates to control it, which in turn can negatively affect the stock market. Interest rates influence the cost of loans for companies and consumers. An increase in rates can reduce spending and investment capacity, affecting companies and leading to a drop in stock prices. Recently, inflation expectations have been a concern, with many analysts predicting adjustments in interest rate policies. Moreover, central bank statements and decisions, such as those from the Federal Reserve in the United States and the European Central Bank, are closely watched by investors. Any hint of change in monetary policies can generate uncertainty and market volatility. In summary, inflation expectations and interest rate policies are critical signals. High inflation can lead to interest rate increases, affecting loan costs and spending capacity, which can result in a possible stock market crash. How to prepare and protect yourself. Given the possibility of a stock market crash, it is crucial to take measures to protect your investments and minimize risks. Here are some practical strategies to keep your finances safe. Diversify your portfolio. Diversification is one of the most effective strategies for reducing risk. By investing in a variety of assets, such as stocks, bonds, real estate, and investment funds, you can minimize the impact of a fall in any specific sector. Geographic diversification is also important, investing in international markets to avoid depending solely on the performance of a single economy. Invest in defensive assets. Defensive assets, such as government bonds, consumer staple stocks, and real estate investment trusts, REITs, tend to be more stable during periods of volatility. These assets often maintain their value or even appreciate when the overall market is falling, providing a cushion for your portfolio. Maintain liquidity. Keeping part of your portfolio in cash or liquid assets allows you to take advantage of buying opportunities when stock prices drop. Additionally, it provides a safety net to cover immediate expenses without having to sell investments in an unfavorable market. Review and adjust your portfolio. Regularly reviewing your investment portfolio and making adjustments according to market conditions is essential. Rebalancing your portfolio may involve selling well-performing assets and buying those that have fallen in value, ensuring you maintain adequate diversification aligned with your investment goals. Use hedging strategies. Hedging strategies, such as buying put options or investing in inverse exchange-traded funds, ETFs, can protect your portfolio against significant market declines. These tools allow you to profit when the market falls, offsetting some losses in other areas of your portfolio. Seek professional financial advice. Consulting a financial advisor can be very beneficial, especially in times of uncertainty. A professional can help you assess your risk tolerance, develop a personalized investment strategy, and make adjustments according to market conditions. Stay calm and think long-term. It is easy to panic during a market downturn, but it is important to stay calm and remember your long-term goals. Historically, markets have tended to recover over time. Keeping a long-term perspective can help you avoid impulsive decisions that could harm your portfolio. Continue your education. Stay informed about market trends, economic news, and investment strategies. The more you know, the better equipped you will be to make informed decisions and protect your investments. These strategies will help you navigate market volatility and protect your finances in times of uncertainty. And that's all for today. Remember, being prepared and well-informed is the best defense against any market eventuality. If you found this video useful, give it a like, subscribe to the channel, and activate the bell so you don't miss our next analyses and financial tips. Leave us your comments and share this video with friends and family who also want to protect their investments. See you in the next video.